Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
Let's jump right into this explainer, because today we are unpacking one of the most complex, high-stakes games played anywhere on the global stage. We're talking about a thrilling, continuous cat-and-mouse game. On one side, you have sovereign states trying to fund public goods and maintain macroeconomic stability. And on the other, multinational corporations doing everything they can to optimize their global returns. Welcome to the multi-billion-dollar tax chess match.
Here is our roadmap for the explainer, mapping out the 6 main battlegrounds of modern corporate taxation. We're going to cover public finance foundations, corporate tax strategy, global transfer pricing, anti-avoidance boundaries, GST and fiscal federalism, and finally, customs and exemptions.
Starting with Part 1, Foundations of Public Finance, where we set the board and the rules. To really understand this game, we first have to figure out who is actually paying the tax. You see, in public finance, there is a massive difference between the statutory impact, meaning who is legally required to hand over the cash, and the economic incidence, which is who actually bears the financial burden after market prices adjust. Think about it. A government might tax a corporation, right? But if that corporation just raises its prices to keep its profit margins exactly the same, well, it's actually you, the consumer, bearing the real economic incidence.
Take the Hayek-Simons income framework, for example. It's a classic accretion model that literally defines what actually gets taxed. The math basically says that your income over a certain period equals your net consumption expenditure, plus the change in your net worth. Essentially, if you bought things to consume or your overall wealth simply went up, even if it's just an unrealized windfall, the government wants its cut. Absolutely all economic gains get thrown into the tax base.
Now, this sets up a massive theoretical tug-of-war in public finance. On one side, we have that Hayek-Simons income tax, which inherently distorts your savings because it actually taxes them twice. It taxes you once when you earn the money, and then again on the returns your saved capital generates. But on the other side, we have a consumption tax base. This excludes net savings completely, which lets your capital accumulate completely untaxed until you actually go and consume it. And this isn't just some abstract theory. This is the exact real-world debate behind whether a country should rely heavily on income taxes or shift toward national sales and consumption taxes.
Moving to Part 2, Corporate Tax Strategy Framework, or the Corporate Playbook. Let's look at the overarching gambit for the corporate player. In the modern era, corporate tax planning isn't just about minimizing your tax bill anymore. It's really about a much broader, more strategic goal: maximizing after-tax returns across all of your business operations. And that brings us to the Scholes-Wolfson paradigm, which is a total game changer. It completely shifts the objective from just unilateral tax minimization to a totally holistic view. You literally can't just look at your own tax bill. You have to look at the tax implications for everyone involved in a transaction. That's the multilateral perspective. You also have to factor in implicit taxes. For example, tax-free municipal bonds might save you on your direct tax bill, sure, but market forces drive their interest rates down, which acts as a hidden implicit tax on your overall return. Finally, you've got cost optimization, meaning you have to balance any tax savings against non-tax costs, like regulatory friction and agency costs. At the end of the day, it's all about the net return. So, this is where financial engineering becomes an absolute grandmaster strategy. Depending entirely on when the government takes its cut, your capital snowballs at radically different rates. Look at how these vehicles fundamentally alter the mathematical mechanics of multi-year tax optimization.
You might use a current model that drags on your returns annually. Or maybe a deferred model letting earnings compound before a final tax hit. Then there's the exempt model, where returns are fully exempt. Or a pension model, where the initial outlay is deductible but taxed at withdrawal. Every single choice changes the math.
And let me tell you, this level of strategy truly pays off. Empirical data actually shows that efficient, long-run tax planning reduces current cash taxes paid by approximately 13% per standard deviation increase in tax efficiency. That is a massive edge. It proves beyond a doubt that these savings aren't just lucky accidents. They are highly engineered outcomes carefully designed by sophisticated corporate tax departments managing both returns and tax risk. All right, part 3, global transfer pricing rules, where we start moving pieces globally. Because as multinationals maneuver these engineered returns across borders, the government inevitably counters. Enter transfer pricing regimes, specifically governed by rules like Section 92C in India, which are designed to protect domestic tax bases from profit shifting between associated enterprises.
Governments basically want to ensure you aren't selling a billion-dollar patent to your own offshore subsidiary for a single dollar, just to shift profits to a lower tax jurisdiction. To prove that intragroup transactions are priced fairly, what they call at arm's length, corporations use one of these 5 distinct methods, and it all depends on the functions performed, assets employed, and risks assumed. For standardized goods, you might use the comparable uncontrolled price. For wholesale, the resale price method. Contract manufacturing usually falls under the cost-plus method. If you're dealing with joint risk sharing, you'd use the profit split method. And for complex shared services or software development, you'd rely on the transactional net margin method, comparing net operating profit margins to a baseline.
Which brings us to part 4, anti-avoidance legal boundaries. This is where the referee steps in. What happens when the legal structure completely ignores commercial reality? Well, the judicial referee steps onto the field and drastically changes the rules of the game to prevent artificial tax avoidance.
The judicial pendulum here has swung wildly over the decades between legal form and economic substance. Back in 1936, the Duke of Westminster case established that as long as the legal paperwork was genuine, taxpayers could totally structure their affairs to minimize tax. Form over substance, right? But then, cut to 1985 in India, and the McDowell case cracked down hard on artificial colorable devices, basically fake schemes meant for nothing else but dodging taxes. Then we see swings right back to legal certainty with Azadi Bachao in 2003 and Vodafone in 2012, before cases like Cairn Energy in 2020 highlighted the strict international limits on governments trying to use retroactive taxation. Following that massive Vodafone ruling, India decided common law just wasn't enough anymore. So they enacted strict, codified General Anti-Avoidance Rules, or GAR. Under these rules, an arrangement officially becomes an impermissible avoidance arrangement if its main purpose is to obtain a tax benefit and it meets one of 4 other conditions. So if it creates non-arm's length rights, results in misuse of the act, lacks commercial substance, or is carried out in a non-bona fide manner, you're caught. The days of setting up empty, paper-only shell companies purely for tax reduction, those are now heavily policed by these statutes. Let's shift gears to part 5. GST and fiscal federalism, where we see the map being completely redrawn. The playing field itself shifted massively in India, with the constitutional restructuring of indirect tax into a unified goods and services tax, or GST. Now, this wasn't just a simple tax change, it was a profound shift in fiscal federalism, suddenly giving concurrent legislative power to both the union and the states.
And this 2022 Supreme Court case perfectly illustrates the friction of this new cooperative federalism. Under this unified system, both state and federal authorities are essentially fighting for the exact same tax pie. In the Mohet Minerals case, the tax authority tried to levy a secondary tax on ocean freight using a reverse charge mechanism, even though the freight costs were already included in the customs import value. The Supreme Court had to step in and successfully strike down this double taxation, firmly clarifying the limits of tax authority reach.
Then we have the secondment doctrine trap from the Northern Operating Systems case. Multinational groups do this all the time. They send specialized staff to local subsidiaries. The legal form looked incredibly simple. A foreign parent pays overseas salaries and gets reimbursed. No big deal, right? But the Supreme Court looked right through the paperwork at the economic substance and ruled that this was actually a taxable supply of skilled manpower. This ruling forced Indian subsidiaries to pay GST on cross-border salary reimbursements, completely upending global mobility structures overnight. Finally, Part 6, Customs, Exemptions, and Synthesis. This is the final threshold of our explainer. We've reached the end game.
The incredibly strict rules for claiming victory at the border by navigating customs and statutory exemptions. Getting a tax exemption is incredibly valuable, obviously, but the courts have made it harder than ever to actually claim one.
This entire dynamic is perfectly captured in a landmark 2018 Supreme Court ruling. Previously, if an exemption was written ambiguously, the taxpayer usually got the benefit of the doubt. Well, the Dilip Kumar ruling flipped that entirely on its head. Now, any ambiguity in an exemption is strictly resolved in favor of the revenue. The entire burden of proof is now squarely on you, the taxpayer, to prove you fit perfectly into the exemption criteria. To survive this gauntlet, businesses must navigate a very strict two-stage interpretive rule. In the first stage, the eligibility stage, the courts apply strict, literal interpretation. There is absolutely zero wiggle room here. But if a taxpayer successfully proves their technical eligibility, then they get to enter the compliance stage, where courts will actually offer a more liberal interpretation of minor procedural requirements. But make no mistake, you must decisively prove your absolute right to the exemption before you get even an ounce of administrative flexibility. So, as we synthesize this highly complex chess match between corporate strategy, the Scholes-Wilson paradigm, and these heavy statutory crackdowns via GAR and strict customs interpretations, we have to ask ourselves one final provocative question. When courts and governments can look right through your meticulously drafted legal contracts to tax the underlying economic substance, is tax planning still a true strategy, or just an exercise in risk survival? Navigating this modern landscape requires balancing brilliant financial engineering with absolutely flawless compliance. Thank you so much for joining me on this explainer diving into the architecture of advanced taxation.
Like what you shared.
This website makes learning so easy. I found all my resources here.
Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.